understand.
Yes, sir. So in 236 page, which one?
Para 24, starting from the loss of control.
Loss of control. Okay,
Yeah.
fine. A parent might lose control of a subsidiary in two or more arrangements, that is, transactions. However, sometimes circumstances indicate that the multiple arrangements should be accounted for as a single transaction. In determining whether to account for the arrangements as a single transaction, a parent shall consider all the terms and conditions of the arrangements and their economic effects. One or more of the following indicate that the parent should account for the multiple arrangements as a single transaction. A. They are entered into at the same time or in contemplation of each other. B. They form a single transaction designed to achieve an overall commercial effect. C. The occurrence of one arrangement is dependent on the occurrence of at least one other arrangement. And D. One arrangement considered on its own is not economically justified, but it is economically justified when considered together with other arrangements. An example is when a disposal of shares is priced below market and is compensated for by a subsequent disposal priced above market.
In the D part, okay, the D part, what they say here is one arrangement compensate the another arrangements. The meaning is this. See, suppose you are going for at your house. I'm telling you, simple example. This one example. At your house, somebody is coming and doing some repair works. It's a Diwali time, and you are doing some renovation or something like that, and some electrician is coming and he's doing the work, and he's asking after doing the work, he's asking, sir, pay me 1,000 rupees. So you are telling him, yeah, now you take only 750. The next time I will give you whatever you ask. I have my work in my office also. I'll recommend you. So you take now lesser. Later on, we'll see it. I will give you more orders and I'll get the new clients from my office and my neighbors. All are there and you will be getting good money. So now you bear with this 750. You may say that, so that type of things are there. So now you are selling at a lesser price. Might be a contract to get more price, higher price or advantage in the second or subsequent transactions. So that is what they said in the point D. One arrangement considered on its own is not economically justified. Yes, the 750 is not economically justified. If he does the electrician, he does the work outside other places, he may get 1,500 rupees. He's already asking you only 1,000 rupees. And I'm reducing it to 750. So it is not economical. He is losing the money. It is not economical. But I'm giving him guarantee. Look, I'm going to give you more clients. You'll get more work. So from them you charge any amount. But as of now, you take only 750. He will accept because he's going to get more work. So with that, he can make a lot of profit. So that is what here the point D, they say one arrangement considered on its own is not economically justified, but it is economically justified when considered together with arrangements. So here in the next other, I'm giving about 10 works I'm giving to him. Each is costing about 2,500. He's going to get income of 25,000 if you accept just one uneconomical one. The first transaction he is meeting with 750. Then he is getting 10 other new works which he can make his profit, in which he can make his profits. That is what they say here. So whenever we see, we should not see just one transaction. We have to consider all the transaction together, so you can decide whether it is economical or economical, what is the effect, what is the consequence on that you can do. So in this 25,000, what he is getting, in that whatever the 10 works, he might have, his cost might be only 12,500. So he has got another 100% more. So that way it is. Okay, so don't look at single transaction. You look at the multiple transaction which are connected to each other. So that is what in the point D they say. One arrangement considered on its own is not economically justified, but it is economically justified when considered together with other arrangements. So this is what they have said. So a parent loses control of a subsidiary. If the parent loses subsidiary, what we have to do? That is in the following part they have given. Sheetal, proceed please.
Yes. So if a parent loses control of a subsidiary, it shall first de-recognize the assets, including any goodwill and liabilities of the subsidiary at their carrying amounts at the date when control is lost, and secondly, the carrying amount of any non-controlling interest in the former subsidiary at the date when control is lost, including any components of other comprehensive income attributable to them. And
Okay.
recognize, yes sir.
One minute. So this OCI, earlier in the, not earlier, still it is there, the accounting standards, we use the term extraordinary items, exceptional items and extraordinary items. In AS 4, 5 and all, we used to discuss about it. Even sometimes AS 29 and all, we used to discuss all these things. Exceptional items and extraordinary items. What is the exceptional item? Exceptional items, anybody can tell me what is exceptional item? Exceptional item, we use it in the financial statements. What is exceptional item? Any one of you? Any one of you? You may try. Okay. No one is ready. Right. Exceptional item is the item which are, yes.
Revenue generated from, we have a normal course of business, and the revenue is generated from not a normal course of business. It may be an exceptional item.
Very good. That is exceptional item. See, it is not through our primary business, but it is relevant to the business. It is not through the primary business, but it is relevant to the business. So you may, not only the revenue, even you can have the loss also. Like you are selling the assets. You are selling your fixed assets and you are getting the income. So, or loss. So that is the exceptional item. It is related to your business, but it is not a regular business. It is not a primary business. So that we call it as an exceptional item. Any profit on sale of fixed assets or loss on sale of fixed assets. So these type of things are, we call it as exceptional item. What is extraordinary item? Which is not at all expected in the business. Which is not at all expected in the business, in any business. If anything happens, then we call that as the extraordinary item, like loss due to earthquake, loss due to fire. All these things are not expected in any business, and any compensation, whatever you are receiving, all these things are extraordinary items. So exceptional item, extraordinary items are there here. Then OCA is nothing but the new terminologies given in the Ind AS to eliminate these things. They call, instead of calling the exceptional extraordinary item, they call this as OCI. That's it. I will be forwarding a PDF. So just kindly go through what is OCI very neatly, very precisely. Anyone can understand that way. It is given. Even an inter student, first time doing just reading this type of literature, he will also understand such a way it is given. I will forward you today evening after the class to you. Is what is OCA? Please kindly go through that. Okay, because we will be doing here OCA. So many times we will be discussing about it. So it will be, yes, you will have the clarity what you are reading. Okay. Yes. Next. De-recognize.
Yes, sir.
Yes, proceed.
So, yes, sir. So we just finished the if a parent loses control, what it shall de-recognize. Now we come to
So
what
what
it
it shall
shall
be,
recognize.
whatever related to the other company as a subsidiary to de-recognize. What all things we have to de-recognize? We have to de-recognize what is controlling interest. If any goodwill is there, that you de-recognize. The liabilities of the subsidiary, all these things will be taken. Basically, they say don't consolidate. The consolidation part you remove it. Just follow 27. But separate balance sheet, you make it in that. If you are investing in other company, whatever you will be doing, do that. Remove everything. Whatever the consolidations are there, the consolidation goes off when you de-recognize. Yes. Yes, Shita.
So yes, sir. So if a parent loses control of a subsidiary, it shall recognize the fair value of the consideration received, if any, from the transaction, event, or circumstances that resulted in the loss of control.
Yeah. So how would you lose the control? You must be selling part of your holding. So you have 70% of the holding. You sell 25% holding. You sell 25% of your shares. Then you get the consideration that is to be considered at the fair value. That's it. So simply they say, otherwise also we will be considering when you are selling your shares, when you are selling your investment, definitely you are going to consider that. They say that consider at the fair value. That's it. Nothing more than that, nothing less than that. So if any result is there, what we have to do, that they have said in the later part. The fair value of the consideration received, if any, from the transaction, event, or some circumstances that resulted in the loss of control. So definitely there will be a consideration. So why do they say the fair value of consideration received, if any? Without consideration, there won't be anything else. There won't be any, losing the control cannot be without any consideration. Okay, next, investment entity. Yes, Sheetal.
So that completes that part. Now next is an investment entity.
Yeah, 1 minute. Loss of control, anything is any doubt, whatever we have read, any point? Because these are the points going to come in your as a small short questions. It will be coming these things. Maybe in the form of some MCQ or in the form of short questions it may come. Okay, just the consolidation part you remove it. That's it. Whenever you are losing the control, consolidation part you remove it. Consider it fair value, and if anything consideration is received, if the consideration is received lesser than the fair value, then you transfer to profit and loss account, you debit to profit and loss account. And if you are getting any consideration more than that, credit to profit and loss account. That's it. That is what they say here. Whenever you are losing the, whenever you are, what you have to recognize after losing the control. Okay. So that is all they have said. The fair value of the consideration received, if any, I won't accept, from the transaction, event, circumstances that resulted in the loss of control, that should be recognized. Just pass the entry. So you get it. Okay, right. Go for it. Next, investment entity.
Investment entity. A parent shall determine whether it is an investment entity. An investment entity is an entity that first obtains funds from one or more investors for the purpose of providing those investor or investors with investment management services. Second, commits to its investor or investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. And third, measures and evaluates the performance of substantially all of its investments on a fair value basis.
Okay, investment companies are all the financial related companies, your banking companies, then your mutual funds, and non-banking, any non-banking financial companies, all these things they say that about these 3 points they have said. Okay, next one.
Yeah.
This is the important point. Point number 2.
Yes.
Sheetal, please underline these points of like we have done previously when we were doing the 103 para 7. I have told you, please kindly underline, please kindly remember these things, very important. The entire substance of 103 is in this paragraph we have discussed. So like that here also, this is one of the very important paragraph. Yes, Shekhar, please.
Yes, sir. Yes, sir. An investment entity shall not consolidate its subsidiaries or apply Ind AS 103 when it obtains control of another entity. Instead, an investment entity shall measure an investment in a subsidiary at fair value through profit or loss in accordance with Ind AS 109.
What is 109? What is 109? 109 is all about accounting of financial instruments. Financial instruments, so your investment, whether it should be considered at what value, that is what the financial instruments we study. So sometimes different methods are there. One of the method is the fair value method, equity method, and there are so many methods are there. Okay. So here they say, so you have to see if it's an investment company, then don't consolidate. Consider the values even of the subsidiary. You may have more investment in a company, you might be controlling, but still you consider that subsidiary, don't do the consolidation, even though you may have the shares more than 51%. If you are a company, investment company, then do not consolidate the subsidiary. Consider your instruments, financial instruments, at fair value. That's it. Don't consolidate. That is what they are telling here. So 103 is not applicable in that case. If the company is the investment company, then 109 should be applied. So 109 is what? Financial instrument, accounting of financial instruments. That is a 109. So that is what they say here. Yes, again, please kindly read this paragraph, Sheetal.
Yes, sir. An investment entity shall not consolidate its subsidiaries or apply Ind AS 103 when it obtains control of another entity. Instead, an investment entity shall measure an investment in a subsidiary at fair value through profit or loss in accordance with Ind AS 109.
Okay, right. There is nothing called a goodwill or what do you say, that gain on bargain purchase, all these things. That is not that. There is no NC and things and all that. So just consider the fair value. The fair value on the date of the reporting or date of acquisition is much higher than what your consideration is on the date of acquisition. If the fair value is much higher than your consideration, then you take it to the credit side of P&L account, credit to the P&L account. If you are paying anything more than the consideration, more than the fair value, the consideration paid is more than the fair value, then it is a loss for you. Generally, you used to transfer to goodwill account, but here you don't transfer to goodwill account, you debit to P&L account. That is what they say in case of investment company. The investment company is explained in the first paragraph in 3 points they have explained. And this point 2 is very, very important, this paragraph. Okay, next paragraph.
Yes, sir. However, if an investment entity has a subsidiary that provides services that relate to the investment entity's investment activities, it shall consolidate that subsidiary in accordance with paragraphs of this Ind AS and apply the requirements of Ind AS 103 to the acquisition of any such subsidiary. Point number 3.
What did you get from this paragraph, Sheetal?
Sir, as such, we are not supposed to consolidate when we are holding purely for investment purposes another subsidiary.
So
But
investment companies need not to consolidate the subsidiaries. That is the first point. Then in the second point, they say, what did you say?
So second point says that, but if that particular subsidiary is providing some services to this investment entity's activities, then it has to consolidate that particular subsidiary as per this Ind AS and Ind AS 103.
Okay, right. Okay. Got it, everyone? So these are the things they will be asking. This type of company they will be giving.
No, sir.
And the investment company will be the subsidiary company, will be providing services to the holding company, parent company. Parent company is the investment entity, and subsidiary is providing services, support services to the investment company, parent company. Should we consolidate or not consolidate? Yes, that case we have to follow 103. That is what they say here. Okay, right. Yes, proceed.
Yes, sir. Last point is, a parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity subsidiary, unless the parent itself is an investment entity.
Okay, that's it. Okay. So the parent company may be a non-investment entity, and they have the subsidiary investment entity. In that case, they can always they can they can consolidate. Only if investment entity is the parent entity and the subsidiaries are not providing services, investment related services to the subsidiary, then we should not consolidate. Otherwise, you have to follow 109. Okay, right. Proceed. Next.
Now, equity method starts.
Okay, right. Now I'll tell you what is the equity method. It is very simple method. Very, very simple method. What we have been doing under AS 14, just you follow, that is the equity method. In the pooling of interest method is known as the equity method. See, the investment increases, your equity also increases. And the investment decreases, the equity decreases. We don't consider this through goodwill or gain on bargain purchase. Anything, whatever is the, just you adjust with the P&L account. When you adjust with the P&L account, other equity increases or decreases. Am I right? Are you getting me? See, suppose I sell my car. The car carrying amount is, let's say, 7 lakhs. I am selling this car for 7,50,000. What entry I will be making? Bank account debit. I mean, in my company. Okay, a company is selling its car, which is a business asset. Carrying amount is 7 lakhs and being it has been sold at 7,50,000. Bank account debit to car account. This is 7 lakhs. 7,50,000 you got the income, and to profit and loss account 50,000. And this is the equity. If you are selling at 6 lakhs and bank account debit 6 lakhs, profit and loss account debit 1 lakh to car, 7 lakh we do it. So this method is what? This is the equity method. Equity method is nothing but what we are doing now. Before India is what we have been doing, that is the equity method. Everything is adjusted through the profit and loss account is the equity method. Okay, right. Whatever they say in the coming paragraphs, everything means this is the only thing. Okay, when the asset side increases, then the equity, that is other equities, increases. When the asset side decreases, other equity decreases, something like that. Okay, right. Yes, Sheetal, equity method.
Yes, sir. The equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in the investor's share of the investee's net assets. The investor's profit or loss includes its share of the investee's profit or loss, and the investor's OCI includes its share of the investee's OCI.
Okay, right. All these just jargons will be this the way they have framed the sentences. It is borrowed from IFRS. So don't worry about all these things. The meaning is this. Later on we'll be doing the problems, so you'll get it very clear. Okay, right. Proceed next.
A joint venturer shall recognize its interest in a joint venture as an investment and shall account for that investment using the equity method in accordance with Ind AS 28. Investments in associates and joint ventures, unless the entity is exempted from applying the equity method as specified in that standard.
That's it. So equity method you have to follow in case of joint venture or joint association. And if it is very specifically excluded, then we don't consider that. Right. Next.
A party that participates in but does not have joint control of a joint venture shall account for its interest in the arrangement in accordance with Ind AS 109 financial instruments, unless it has significant influence over the joint venture, in which case it shall account for it in accordance with Ind AS 28 and 27.
Okay, a simple thing I will here in the equity method. So we have discussed about loss of control, we have discussed. Then equity method. Okay, here some of the things what we're supposed to understand is no control and no influence. No control and no influence. Then we have to follow. We have to follow Ind AS 109. No control, no influence. Just we have made the investment. We don't have any control. So we have to follow Ind AS 109. What is 109? In 109 is financial instruments. So like anything, the equity method will be following no control, no influence in the management. Then we will be following Ind AS 109. It is a simple investment. Like any other investment, this is also an investment just to earn profit, nothing more than that. So because you may invest to have the control in the other entity. So there we will be applying 103 and 110. When you are investing some just for the purpose of interest or for the purpose of the dividend or something like that, income, return, then we will be following Ind AS 109 financial instruments. Right. And the second one is no control to power. Right. Can influence significantly. So here we will be applying Ind AS 28. So this is the thing we have to. So here no control to power but can influence significantly. That means it is a joint venture. It's a joint venture or the joint association. So your association with someone may influence the control. Though you don't have the clear control, still you can significantly influence the management of the company. Then we will be following Ind AS 28, which is joint venture and accounting of joint venture and joint association. So these two key things we have to understand: no control, no influence. Just you have invested, Ind AS 109 has to be applied. That is just like any other investment, you are considering this also investment, and you are not interested in the control of the another entity. no control to power, but can influence significantly, then we will be applying Ind AS 28. So this can happen only in case of joint venture and joint association. Okay, right, proceed. Go for this problem. So they are given here. Company P Limited. Now you can tell me. Okay, you will be telling. Okay, company
What is
P.
27, sir?
27. What is 27? Tell me. It is separate balance sheet, separate financial statement. Just making normal financial statements of a company. That is 27. Ind AS 27 is separate financial statement. Okay, sir. Yes, Anandji. Okay. Acha, he's trying to say something and he's not connected, I think so. Right.
Sir.
Okay. Right. Shall I proceed further? Chaliye, right. Now see this problem. P Limited, a listed company, acquires 20% shares in Q Limited on 1/4/2017 at a cost of 46,000 paid by cash during the financial year 17-18. Q made a profit of 20,000 and other comprehensive income 1,000. 1. Investment entails 20% voting power and significant influence over Q. P does have joint control of Q, a joint venture. Investment entails significant influence over Q, which is a joint venture. P does not have a joint control of Q. P does not have significant influence over Q. P does not have joint control or significant influence over Q, which is a joint venture. For each class 1, 2, 3, 4 and above, state whether the investment in shares of Q P requires preparation of consolidated statement and separate financial statements. Past journal entries in the books of P at the time of purchase of shares show relevant accounting treatment at the end of the year 1, consolidated financial statement, separate financial statement, and individual financial statement. So this is the question, and this is the question. I think, yes, this can come for at least for 6 marks, it can come. Very simple one. So I have already given you the clue how we have to identify this. So illustration 17. Okay. I already told you, in case it is to be considered as 109, there should not be any control, there should not be any this one. So we will be following just the equity method. So just you are investing, make it investment account debit to cash. Paid by cash and the financial year and made. Later on, they say whatever the things are that we can see it. Okay, right. So here first, P does investment entitles 20% voting power and significant influence over Q. So what we have to do, there is a no control to power, but as influence significantly. So what we have to use is 28 we have to use, and Ind AS statement is 27 for the normal separate financial statement. Right. So they have given the answer C here. In case 1, what is the first one? State whether the investment of shares of Q P requires to prepare the consolidated financial statements and separate financial statement. They say in case 1, 2, 3 P Limited requires preparation of consolidated financial statement for its investment in Q Limited. Because here first one entails 20% voting power and significant influence. Then it is a joint venture. Yes, AS 28, in AS 28 we have to follow. In the Ind AS 28, we will be considering consolidation is to be done. Okay. In joint venture, joint association, you have to make the consolidated financial statement. So the first case, P does have control what they say, investment entitles 20% voting power and significantly influence over Q. Yes, we have to prepare consolidated. Okay, second case, P does not have joint control of Q, a joint venture. Any joint venture, you have the control or you don't have the control, then you have to consolidate. Joint venture, you have to consolidate. Joint association, you have to consolidate. That is what it is said in 103. So the 103, they say that if it is a subsidiary, then go for 110. If it is a joint venture, then go for the Ind AS 28. In all these cases, you have to consolidate. That is what they say. So here we have to consolidate. Second also, because it is a joint venture. Third case, investment entitles significant influence over Q, which is a joint venture, and P does not have joint control of Q. So investment entitles significant influence over Q. So if you are having control, no control to power, but can influence significantly, Ind AS 28. Ind AS 28 means you have to consolidate. Only Ind AS 109, you need not to control. You need not have the consolidated financial statement. But when there is a control and power to influence, yes, you have to consolidate. When there is no control to power, but can influence, yes, you must follow the Ind AS 28. Wherever you have to follow 110 and 28, you must do the consolidation. So here the third case also we will be doing. P does not have significant influence over Q. Definitely you need not to do anything, so no consolidation. P does not have joint control of significant influence over Q, which is a joint venture. P is not joint venture. Q's business is a joint venture. P has investment in Q. P does not influence Q. Q is a joint venture. So should we do, so this will go under what? It will go under 109. It won't go under 110 or Ind AS 28. So when it doesn't go under 110 or 28, there won't be any consolidation. So that case also we need not to make any entry, because P is not a joint venture or joint control. Okay, right. The company Q is a joint venture, right? So the first entry, first case, we have discussed all these things. Please kindly read the answer. Are you getting this or not? Let me know. One more thing I'll tell you. No control, no influence, Ind AS 109 we have to apply. So 109, no need to consolidate. No control to power can influence significantly. Yes, Ind AS 28 is to be applied. And if you are a joint venture, yes, Ind AS to be applied. A joint arrangement, yes, Ind AS 28 is to be applied. Joint arrangement with influence. Okay. No, that cases joint venture will be coming. So here, first case, investment entitles power as well as significant influence. Yes, Ind AS 28 is the consolidate karna. Second case, P does not have joint control of Q. P does not have a joint control of Q, but P is the joint venture. P does not have joint control, a joint venture. So P is doing joint venture with Q, but they don't have the joint control. In that case, still P is a joint venture. Therefore, this company is a joint venture. I'll tell you. P does have joint control of Q, a joint venture. Okay. Okay. Third, investment entails significant influence over Q, which is a joint venture, and P does not have joint control of Q. Investment entitled significant influence over Q. Okay. Q is a joint venture. P does not have joint control of Q. Doesn't matter. So still it will be AS 28 will be, Ind AS 28 will be applied. When Ind AS 28 will be applied? When there is joint venture, then significant influence. Joint control. Power to control. All these cases, consolidation will be done. A company is a joint venture company, it has to consolidate. The entity has the significant influence on another company, yes. Joint control, they have, yes. Power to control, yes. The first three cases you will be using in AS 28. In the fourth one, power to control, you will be using AS 110. In these three cases, in AS 28. In this case, in AS 110 applicable. So these are the cases you have to consolidate. Okay, so you get the answer for the A, B, C, D. Sorry, A part. Okay. So in the consolidating separate balance sheet, how the entry is to be done here. Journal entry for the first 1, 2, 3. 1, 2, 3 we have to follow in AS 28 we have to follow investment account debit to bank. First case, the B. For Ind AS 28, entry will be investment account debit to bank. Okay, and for Ind AS 109, what entry will make? Also same thing, investment account debit. This is entry we'll be making. So Ind AS 28 is 1, 2, and 3. Ind AS, this one we do, and here 3 and 4. So 4 and 5. 4 and 5. Okay. So P does not have significant influence over Q. It is 109. P does not have a joint control in the significant influence over, which is a joint venture. Q is the joint venture, they say here. So P, we are making the entry in the books of P. We are making the entry in the books of P. In this case, also the similar entry will be doing it. Whatever the amount is there, that will be doing. End of the year, you have the profit. End of the year, we have the profit. For class 1, 2, 3, there will be two sets of accounting at the end of the year 1. One is a consolidated, another one is a separate one. For consolidated accounts, Ind AS requires the recognition of investments by equity method. At the end of the year, the consolidated accounts of P Limited adjustments are made to the investment and income accounts as per equity method. I told you what is the equity method and the investment. The investment 6,000, profit and loss account 4,000, and other comprehensive income 2,000 they have given here. See what is other comprehensive. I already told you that extraordinary item is removed. Only the heading is changed. The extraordinary items. It is changed with what? It is changed with the other comprehensive income. So it is a just change of name. But here we have to recognize separately the OCI and separately the profit of the year. The problem they have given, end of the year, they have made a profit 20,000 and other comprehensive income 10,000. So 20,000 got 20% and 10,000 20% that they have taken here. So total 30,000, 30,000, 20%. Your interest will be here 20% of 30,000, which is 6,000. And that has the two components. One is the regular profit, the revenue profit, profit from the regular business operation. Another one is the extraordinary items, profit from the regular business operations and the extraordinary items. So the extraordinary items, you have to take it to the extraordinary item separately, you have to account, and the regular profit you have to identify separately. So that we will be doing at the end of the year. So that is what they say here. Here total profit is 30,000 for the year, and in that earning from primary operation and earning from extraordinary. So this extraordinary, the name is changed now, other comprehensive income. So OCI. So in this you will be getting, here it is 20,000, here it is 10,000. So your share will be 20,000 into 20%. So which is 4,000, and 10,000 into 20 by 100. So that is 2,000, and here 30,000 into 20 by 100. So this is 6,000. So here end of the year we have recognized the two entries are there. Here two different things are there. First is investment account debit 6,000, to profit and loss account 4,000, to other comprehensive income 2,000. So now the investment is increased from 44,000, initially how much, 46,000 to 52,000. The investment increased from 46,000 to 52,000. So 4,000 we will be transferring current year profit to profit and loss account, and other, this one will be, it will be remaining in the comprehensive income. Okay, so this is what we'll be doing here in the this one. Okay. Second point, what they say, at the year ended separate financial statement, piece investment is valued at cost 46,000 at a value of 109 at a fair value through OCI. In case 4 and 5 as per 109, the fair value through OCI in the individual financial statements. Okay, right. So, कुछ समझ में आया? Are you getting or not? Not getting.
So not getting.
Not getting. Okay, right. See, different situations are there. So at the time of investment, in case of anything, whether it is a 1, 2, 3, 4, 5, anything, the initial measurement, we will be considering investment account debit to bank. This is the one. Whether it is consolidated report statement or whether it is individual financial instruments, whatever you are doing it, So the entry will be for all the cases invariably on the date of investment. On the date of investment, on the date of investment, I have not used acquisition. I have used the word investment. On the date of investment, we will be considering investment account debit to bank. How much is the amount? 46,000. Invariably, all the cases 1, 2, 3, 4, 5, any joint venture or 109 and 28, the entry will be investment account debit to bank for purchase, because it is not acquisition. It is either joint venture or it is 109, a financial instrument, normal investment we are doing. This will be the entry, investment account debit to bank. This is the initial measurement. On the date of investment, initial measurement, whatever the amount you are investing, you will be considering that. Very clearly they have said, you have got the money through regular business income. You have got the money through regular business income. That is 20,000. And you have got the money extraordinary items. Through extraordinary item 10,000. So in case of 28, we have to recognize this separately. And everything will be added with the investment. Everything will be increased investment. So on the date of say the date of end of the year, okay, not on the date, end of the year. Recognizing the return. What we will be doing, we will be in case of AS28. In case of AS20, in the AS28, we have to increase the investment. Just we have to increase the investment. No fair value will be considered, and whatever the profit is coming, just add with that. This is what we'll be doing. So here, what we'll be doing, investment account debit. For Ind AS 28, that is 1, 2, and 3 for these cases. End of the year, investment account debit to profit and loss account to other comprehensive income. We will be identifying extraordinary items as extraordinary items. We will be identifying the revenue return as a revenue return, and both will be increasing the value of investment. So we don't directly transfer bank account debit to P&L account, something like that, or dividend receivable or something like that. We don't transfer. So we do this entry for the consolidation. We do it. So this will be added with the investment, and it will be added with the P&L account and other comprehensive income. Okay, right. So here we had 6,000, 4,000 for this, and 2,000 for other comprehensive income. Okay, this is in the consolidated one, right? Okay, this part is now over. Now 3 and 4 is 109. 3 and 4 is 109. In the 109, the investments here at the year end of separate financial statement of P, investment is valued at cost 46,000 at a value as per Ind AS 109 fair value through OCI. The investment valued at cost 46,000 or at the value as per Ind AS 109. So in case of 109, so here what is the second one they have asked here? Second one is P does not have the control over Q, a joint venture. And 3 is this was the one. Okay. Third one is Ind AS 4 and 5 as per 109 at the fair value it will be considered. So in the second case, P does not have joint control of Q, a joint venture. In that case also we will be using the 109 method. In the 109 we have to consider at cost, and whatever the income is there you need not to differentiate as P&L account and OCI. Don't consider the investment, whatever the earnings are there, you compare the fair value. Don't consider this income. Compare the fair value and consider everything at OCI. So everything at OCI we have to consider and not the P&L account. That bifurcation you needed to do. Other than the first one is what? First one is investment in entails 20% voting right and significant joint venture. So in that case, the consolidation we do like this, and other cases it will be going in the comprehensive income. You need not to consider anything. Anything you need not to consider. Everything will go to comprehensive income at fair value through OCI. So whatever the difference is between the fair value and let's say it's 46,000 here. 46,000 you bought it. Okay. You bought it for 46,000. It's the cost of acquisition. Cost of purchase. Cost of investment 46,000. This is on 1/4/2019. And 1/4 fair value on 1/4/2020. Let's say fair value is either 55,000 or 40,000. We'll be adjusting this as a extraordinary items. So we'll be taking this fair value 15, whatever the increase is. The increase is 9,000. In this case, two cases are there. This is A, this is B. Two cases are there. Here it is a comprehensive income. Other comprehensive income will be taking 9,000. And here we'll be taking other comprehensive income minus 6,000. Other comprehensive income minus 6,000 we'll be taking. So case A, other comprehensive income rupees 9,000. We'll be adding this. And case B, the value is decreased, fair value is decreased. So other comprehensive income we'll be taking as minus 6,000 rupees, minus 6,000. So this is what they have said here, and I'll be doing the problems with the Ind AS 109. I'll be sending the problem here. Also some of the areas, I think some problems they had given here, if I'm not wrong. One or two problems are given for 109. One minute. It is there in the page number. Not given the problem 109. We will be doing the problem. I'll give you, because it consists of 3 A's, 32, 107, 109. So I'll get you the problems in this case. Okay, we'll do the problems in the next class, or in the extra class, addition class. We'll do the problems for this. Okay. All right, go for the next one. Preparation of group cash flow statement. Group cash flow statement is not a problem. Whatever the problems are here, just do it. Here there are how many problems are there? 1, 2, I think 5 problems are there. 18, 18, 19, 20, 21. That's it. 18, 19, 20, 21, 22. We have only these many 4, 5 problems are there. It is not different from what we have been doing. So 3 activities are there in the cash flows. Cash flows, we have 3 activities. Which are the 3 activities are there? Which are the activities? Operating activity, and the second one is investing activities. And third one is financing activities. Financing activities. These are the 3 activities are there. So operating activities, cash generated through regular business operation, that we will be considering in the operating activities. And one case will be coming here, investments in subsidiary. Investments in subsidiary. Generally, we consider in investing activities, we will be considering here little differently. We have to consider that. That we will be discussing when we do the problems. We'll be discussing. So investing activities all about investment through non-current assets. Cash generated through cash flow through non-current assets, whatever is there, that will be coming under investing activities. And the financing activities are the activities which are non-current liabilities and cash flow generated from non-current liabilities and the equity. Non-current liabilities and equities. Through that, if you have created any, whatever the cash flow generated, we call it as a financing activities. How many of you don't know anything about the cash flows? How many of you don't know anything about the cash flows? Any one of you? Any one of you? So everyone knows about it. Am I right? Hello. Okay, right. So I need to tell here you have in the operating activity only you have 2 methods. The first one is direct method and the other one is indirect method. Rest everything is the same one, only one method is there. So okay, right. If any loan given to subsidiaries, even if it is a current asset, that is to be considered in the investing activities. See, generally the current assets and current liabilities we are considering in operating activities we consider. But in case if it is a subsidiary, loan to subsidiary, loan received from subsidiary and loan given to subsidiary, all these things are to be considered in investing activities. You remember this simple one. Okay. Right, let us go for the problem. Problem number. Okay, the direct method also everyone know the difference, direct and indirect method. Direct, indirect method, operating activities, everyone knows. Direct method, everyone knows, because generally people do indirect method. Someone answer me.
Yes, sir.
Okay, right. Right. So I'm going for the problem here. Okay.
No doubt.
Hanji? Yes or
No
anything?
doubt.
No
Sir,
doubt.
excuse
Okay.
me.
Okay. So should I do the cash flow or I should skip it? Or
Sir,
one problem?
I have a doubt. Can I ask you, sir?
Yeah.
Sir, in the index method, the starting point is net profit, and then we add back all non-cash expenditure, and then we reduce all the non-operating income. Why do we reduce that non-operating income?
Because it
What is the
doesn't. Okay, right. See, suppose, let's say, I'm studying, I'm a student, and I'm going for my training also. In the training, I'm getting stipend of 10,000 rupees. I'm getting stipend per month. Training, I have area, so filing the return, income tax returns, and all. I know I have been doing in the office, and I get the money from my private sources. I'm doing filing the return, not for my firm, not where I'm doing the training. I'm privately. I'm giving offering the services of filing the return for the salaried people, simple one. So I get some money out of that. Also, I'm getting about 2,000, 3,000 rupees per month. My total income is 13,000 rupees. Is that right? 10,000 I'm getting my stipend. That is from my firm where I'm doing the training. And 3,000 I'm getting by the additional jobs and my private job, filing of return for others, providing services of filing the return to others. Tell me now, my income for traditional, sorry, not traditional, my stipend income is how much? Can I say that my total income is stipend income because I learned filing of return in my training? So can I include this 3,000 also in my stipend? So I'm getting stipend 3,000. Yes, Arun?
Sir,
Are you getting me what I'm telling?
extra income need not be added, no, sir.
Okay, that is not my stipend. Though I have learned how to file the return from my training, still I will not include this income because this is not given by my the principal under whom I am doing the training. It is I have learned from him, but I am earning privately. So it should go to my private income, not in the stipend income. Like that, I have surplus in the surplus funds I had that I have invested outside my business. Through my regular business services, whatever I'm earning, that is the primary business cash flow generated from the primary business. That should go to income from operating activities, cash flow from operating activities. And my surplus fund, it is through the investment I got, so it should go to the investing activities. But the net profit is including all the profit. That net profit doesn't see whether it is from my regular business, whether it is a comprehensive income, whether it is exceptional income, whether it is extraordinary income. It doesn't see everything. After doing all these things, adjusting everything, then my net profit comes. So that is the reason it should not be here. It should be in the other head. So I'm subtracting that.
Okay, sir.
That is the reason, because it should come under the investing activities, not under the operating activities, but the net profit is including all the income. So I'm subtracting that income. That's it. Any other doubt?
So that extraordinary income, where it will be finally shown?
That will be shown as the income in the investing activities. We subtract here because it is not the trading income. So we show it in the investing activities, the inflow. Okay. Say yes or no.
Yes, sir. Yes, sir.
Okay. Anybody else? Any other doubt you have? And one more thing, the books, what they have followed, I'll tell you. Okay. So this is in case of provision for tax B. Provision for tax, we have three different cases. One is when given only in adjustment. Second is when given only in comparative balance sheet. And third, when it is given both in balance sheet and in profit and loss account. Sorry, adjustment. And in adjustment. So these are the three cases are there. So in the first cases, the same amount will be considered as paid as well as provided. So both things will be added in the income. So in the component, from the cash flow from operating activities, we will be adding it and we'll be subtracting it as the tax paid also. The same amount will be case one, same amount will be added with net profit as tax provided and subtracted as tax paid. In operating activities. Case 2, when it is appearing only in balance sheet, what we'll do? Treated as paid, treated as tax paid. And subtracted from operating activities. Subtracted in operating activities. Current year added with net profit as tax provided in operating activities. Why should we do this way? Can anyone say this? A reason for this? Why should we say this? Why should we do this way? Any one of you? What is the reason? What's the reason?
Sir, is it because it is a below the line adjustment?
What is below the line adjustment?
It's an appropriation of profit. It's not a charge against profit. It's an appropriation of
That is all right. But why we are subtracting previous year as tax paid And why should we consider as the tax provided the current year? Always provisions are, yes, it is charged against the, it is appropriation. Okay, right, that is all right. But why should we subtract?
Is it because the current year's tax that we provide on 31st March, say, we'll be paying it in the next financial year? It's not yet paid. We are just providing for it.
You pay everything in advance. Advance tax is already there.
Oh yeah. Sorry.
Yes, anybody else? Shilpa? Why Shilpa is not responding at all? I have asked her some questions. She didn't. Okay, for this also no answer. Okay. Acha. Right. You don't know the answer. Okay, Shilpa. Okay, right. Okay, I'll tell you the reason. What is conservatism principle? Principles of prudence. What is principles of prudence? What is principles of prudence? Any one of you? What is this, sir? You are asking in the final level, you are coming and asking the foundation question. People do it in 11th. Don't ask us. Anticipating of losses and not the profit. Okay. So what do you have to do when you anticipate, Chetan? When you anticipate, what should you do?
Sir, it's maybe by provision or reserve.
You have to create the provisions. Okay, right. So that is, yes, good, Chetan. Right. So as per conservatism principle, the principle is provide for future expenses and losses, ignore future profits. Provide for future expenses and losses, ignore future expected profits. What does it mean? So if you are expecting any losses in future or expenses in future, so you create the reserve for that. Like that. The previous year, we have provided for the current year. We have provided for the current year. So whatever we have provided in the previous year, we have paid in the current year. This is what the assumption we are making. As per conservatism principle, provisions are made. We have anticipated this much tax in the previous year for the current year. Therefore, we have provided. Suppose this year is 2021. So in the 1920, you have expected tax this much for 2021. So you have provided in the previous year. And whatever the provision you are making, this is expected tax provided for succeeding year, that is 21-22. So what I'm assuming is previous year we have provided, that is spent during the current year. So treated as the tax paid and subtracted from the operating activity. And whatever I have provided during the current year, this is not spent. There was no cash flow for this. So it is provided for the next year. अभी तक उसको कुछ pay नहीं किया है. Therefore, I am considering this as a provision, adding back with the profit. This is the reason why we are doing it. So this is all right for provision for tax. But sometimes back before the amendment of accounting standards and after the amendment, when Companies Act 2013 had come, within 30 days you have to pay the dividend payment. The proposed dividend cannot be shown as the line item. Line item means it cannot be shown in the balance sheet. Coming under different heads, one of the item you cannot show it. Trade payables, line item. borrowings line item, equity share capital line item, PPE line item, cash and cash equivalents line item. So here they say the provision for proposed dividend should not be shown as a line item. It can be shown under the notes to account as a footnote. The second note to accounts is what? Other equities. Under other equities, you can show this as a dividend paid or proposed, whatever dividend proposed, whatever is that you can show it. But you cannot reduce it from the profit, and you cannot show it as the what? As a line item. Therefore, that part is over. That is not there. But our institute has not forgotten that. They have applied that. So the same thing will be applicable for the proposed dividend also. So whatever is applicable for the provision for, the same thing is applicable for the proposed dividend also. Okay, right. Third case, case 3. Provision for tax. So it's a liability account. Therefore, the opening balance will be there in the debit side, isn't it? So buy balance brought down. The opening balance will be there. To balance carried down. The closing balance will be there. Either what will be missing in the third case, it is given both in balance sheet and adjustment. The balance sheet they may give you, either tax paid or tax provided. So here we will be writing tax provided by P&L account. This is tax provided during the year. And provision for tax to bank. This is so we have to subtract this in the operating activities. We have to subtract this, and the operating activities we have to add this. Dividend is being paid by company after introduction of Companies Act 2013. Proposed dividend can never be shown as a line item in the balance sheet. Proposed dividend can be shown as the line item in the balance sheet. I have told you what is the reason for that. Proposed dividend cannot be there because within 30 days from the date of declaration, it should be paid. When you pay it, what happens? There won't be any balance. So if it is proposed, it is to be immediately, it is to be paid. How you can show it as the line item? There won't be any balance in the proposed dividend. When there is no balance, it cannot appear in the balance sheet. So that is the funda behind it. But still, our institute has given the proposed dividend also in the questions. The proposed dividend funda is also applicable here. Same proposed. So here for proposed dividend. Because we have to follow the book, whether it is right or wrong. For the sake of getting marks, we have to follow the book. It is wrong, I know. Still, whatever there in the study material, we are following it. Okay, right. So here also the 3 cases are there. The first case is case 1. Appears only in adjustment. Case 2 appears only in balance sheet. Case 3. Appear both in balance sheet and adjustment. So case 1, what we will be doing, added in operating activity as proposed, subtracted in financing activities as paid. Okay, this is for case 1. Okay. Case 2. Previous year. Subtract minus in financing activities as paid, dividend paid. Current year. Add in operating activity as proposed. Same funda, what we have discussed, same funda. Right. Now case 3. So here we have to make the account. Same way. So here proposed dividend by balance brought down to balance carried down by P&L account. Operating activities add to bank, dividend paid. Financing activities minus. You see that same thing will be there here also, same thing will be there. Okay, so this is the way we have to do in case of this one. Let us go for the problem here. Okay. Okay. Let us okay. Problem number 19. Number 19. Problem number 19. Yes, Sheetal, please kindly read.
Sir. Sir,
Yeah.
read the okay. The wait, I just got.
Only adjustment. Page.
Yes, sir.
Page number 244. Only adjustment just
Yes.
read.
Okay, sir. The other information states that first, fixed assets costing 4 lakhs, accumulated depreciation 3 lakhs were sold for 1,50,000. Second, actual tax liability for 2015-16 was 5 lakhs.
Okay.
Third, loans represent long-term loans given to group companies.
Okay.
Fourth,
See here, beside that, long-term loans given to loans represent long-term loan given to group companies to be considered in investing activities, not in any other activities, should be considered under investing activities. You just write if subsidiary companies anything received or paid to be considered in the investing activities. Okay, right. Yes, proceed.
Yes. Fourth, interest on loan funds for 2015-16 was 14,21,000 and interest and dividend income were 4,02,000. And
Okay,
last point,
last point.
investment. Yes, sir. Investments costing 20 lakhs were sold for 25 lakhs.
Okay, right. Cash flow statement. Not necessarily you have to get the same answer as in the illustration. Depends on our consideration. Everything changes. Some of the areas other you can consider either way, right? And current items and current assets and current liabilities. The working capital changes. If you are following whether direct method or indirect method, it should come in the operating activities. The current assets and current liabilities other than cash and bank. Okay. Tell me, provision for tax, where should we show? Provision for tax, under which heading we are showing?
Operating activities, sir.
No, I'm asking in the balance sheet under which heading we show it, under which head we show it.
Current liabilities.
Current liability we show it. But provision, any provisions, it is appropriation of profit, isn't it? Provision is appropriation of profit, should not be shown as a current liability, should be considered as a non-current liability because it is appropriation of profit. Why should we show it as a current liability? Okay, not relevant our this one. So you find out the answer and you tell me later what is the purpose of it. Okay, how we have to proceed for this? Hanji, yes.
Provision for debtors is a charge against profit.
I am asking provision for tax.
Provision for tax is okay.
Provision for tax should be, it is appropriation of profit, isn't it? Cash flow from operating activities. Then why do we show under current liability? Who will answer me? Net profit. Yeah. And tax provided. Dividend proposed. Transfer to general reserve. Transfer to other reserves, if anything is there. So we get profit before tax. Add non-cash expenses and non-operating expenses. The expenses which are related to other activities not to be subtracted from the net profit. Okay, so whatever is subtracted, that is added back. Non-cash expenses and non-operating expenses less non-operating incomes. So we get cash flow before working capital adjustment and less this. So I have taken here inflow and outflow. So use the log principle. So this is inflow. Increase in current liabilities, decrease in current assets are inflow, and increase in current assets and decrease in current liabilities are outflow that we adjust. So cash flow after working capital adjustment less tax paid. So we get cash flow from operating activities. Second, cash flow from investing activities. Then cash flow from financing activities. So 5-6 lines. You deliver 3. Total 1 plus 2 plus 3. Add opening balance of cash and cash equivalents. So we get closing balance, cash and cash equivalents. And open 2-3 accounts and keep it ready so that in case if you need the information we can open the accounts. Okay, right. So after this, just I have opened the accounts and given the space. Now you go for the problems. First, find out what is the net profit here. Closing profit minus opening profit. So this is not a net profit. There is a net loss. Net loss 250. Okay. Because opening profit is 250 and the current year profit is 0. So 0 minus 250 is minus 250. That is a loss. Okay, loss. Is there any transfer to general reserve or something like that? 4,300 here also decrease. So it will come under non-operating transferred from general reserve. How much is that? 200. Okay. Right. Then go for the adjustments now. Do everything simultaneously. Go for the adjustments. Fixed assets costing 4 lakhs, accumulated depreciation 3 lakhs were sold for 1,50,000. Okay, right. We have fixed asset account. and accumulated depreciation account. So how much the fixed assets at cost to balance brought down? How much is that? Gross block is 21,000 and 22,400. 21,000 and 22,400. Then accumulated depreciation is 3,200 and 3,450. 3,450. By balance brought down to balance carried down. Okay. Fixed assets costing 4 lakhs, accumulated depreciation 3 lakhs. Sold for 1,50,000. So here cost 4 lakhs. This is statement of sales. Cost 4 lakhs minus accumulated depreciation 3 lakhs. So the book value is 1 lakh. Sold for 150,000. Profit on sale 50,000. So here to fixed assets. How much is this? 3 lakhs. By accumulated depreciation 3 lakhs. By bank sales 150,000. To profit on sale 50,000. Okay, so this will be profit on sale of fixed assets. So all the values are in thousands here, rupees, thousands. So this will be, I have to take this as 50. Okay, here sale of investment 150. Depreciation has come. Now close this. So this is 3 lakhs. I have to write this as 300. This is 3,200. Okay. Here also I have to write as 300, 150, 50. Okay. Close this 3750. 3750. So profit and loss account 550. So here depreciation will come as a non-cash expenses. Depreciation on fixed assets 550. Close this account, you will be given purchase. So 22,400 plus 150 plus 300 is 22,800. Minus 21,050 is 1,800 to bank. So here purchase of fixed assets 1,800. Next adjustment, actual tax liability for 2000 16 is 5 lakhs. तो हम यहाँ tax paid is 500. Tax provided bank sheet made. Nothing will happen because here it is provision for tax 500 and 0. So if you make the account 500 paid 500, there is no balance here. Okay, right. This is over. Next, loans represent long-term loans given to group companies. So a loan given to group companies should be considered as investing activities. कहाँ है loans represent? So here how much is that? 200 and 1700. So we have given loan. तो यहाँ आ जाएगा loan given to group companies. $1,500, $200 and $1,700. Okay, right. That is over. Interest on loan funds 2015-16, 14,21,000, and interest on dividend income is 4,02,000. Interest on loan funds where it is there, loan funds. Loan funds, it is a part of unsecured loans. How much is this? 9,10150. Okay, so we have paid interest on loan. So interest on loan. Interest on loans. That is 14,21,000. So 1421. And take it in the financing activities. Interest paid on loan funds. $1,421. Investment costing 20 lakhs were sold at 25 lakhs. So dividend income is 4,02,000 EB. So we have to take that also. Dividend income 4,02,000, 402. It will be coming in the investing activities. Dividend from investments 402. Right. Investments costing 20 lakhs were sold at 25 lakhs. So we have profit on sale of investments. How much? 500. Sale of investment 2,500. To open the investment account. Investment account. Balance brought down. How much? Investments. Investments 2,320 and 1,650. Buy bank 2,500. Profit on sale 500. कितना हो गया 2500 प्लस 1650 4150 minus 2820 is 1330. To bank, this is purchase 4150. So here purchase of new investments 1330. 1330. Okay. Then next adjustment, sorry, adjustments हो गया. Now we can go for the regular items. Equity share capital 7,000 and 8,500. So the issue of equity shares, how much? 1,500. Okay. General reserve done. Penal account is over. Security premium. So security premium, how much it is increased? 1,800 is increased. Okay. Then secured loans 5,000, 4,800. Repayment of loans. So repayment of loans. No. With the shareholders fund. Then secured loans are 5,000, 4,800. So 200. Okay. How much is the security premium? It is security premium is not this much. Security premium is 750 and 1,500. So this is another 750. Equity share capital is this. Okay, right. Total हो गया. Then shareholder secured loans 48. This is over. Unsecured loan. Okay. Raising of unsecured loan. How much is this? This is unsecured loan is 4,000 and 5350 1350. 1350. Then total loan funds has come. Sources. Fixed assets I have done. Okay. Capital work in progress. So investing activities. Capital work in progress. It is 1860. Investments 2320 and 1650. Okay. Okay. Current assets, loans and advances, inventories, it is in decreasing. Okay. So decreasing inventories, decrease in inventories. So 2240, 2150 is 90. Okay. Then next datas are decreasing. Decrease in datas. How much? 1,200 and 190, 1,090. So 110. Okay, right. Cash and cash equivalents 120, 280. Cash and cash equivalents. So this is 280 and 120. Okay. Loans we already taken. Advance tax. It was 0, 0. and the creditors 1200 1050. So this is decrease in creditors.
Sir, you're on mute.
Okay. If any arithmetical error is there, please let me know. Okay. 1421, 1421, 200, and 2800. Four, 421, 750 plus 1500 plus 1350, 2600. 821. Cash outflow from financing activities. 821 minus. How much discount? Somewhere some error is there. Okay. 200 minus 250 is 3150 TK. $200 plus 50 plus 402 plus 500 is 1152. This is 1152. 3150 plus 2021. 4019. This is plus 230 minus 150 is 4099. Minus 500 is 3599. This is 3599. 1500 plus 1800 plus 1330 plus 1860 is 6490 minus 3052 is 3438. Okay. Interest paid on debentures, repayment of loan, dividend paid, security premium, sure equity shares, raising of funds. Okay. One four two one plus 200 plus 2800 is 4421 minus 21. That is right. So here 821 3599 minus 3438 minus 821 is 660. So there is so here you're supposed to get here how much you have to get 120 you have to get here, so 280 minus 120 you're supposed to get 160 here, so there is a difference of 500. I don't know, you have to total it. There must be some printing error in this. Okay, there is a difference of 500 rupees. 500 rupees. Our totaling error, it cannot happen because I have checked it up. So whatever we have done, everything is perfectly correct. So here there is a difference of 500. I'll find it out and I shall. Operating 4099. It is not 4099. Yeah, it is operating in 3599. Where it is 4099. I'll total once again. Maybe in the book they might have given 4099.
Sir,
The book they might have given 4099, but I have taken everything, whatever is there. Everything I have taken here. 200 minus, what is this? Transferred from general reserve. Yes, I have taken in the non-operating activities. And change in profit and loss account 250 we have taken minus. Proposed dividend 3400. Yes, we have added. Provision for tax 0. Okay. And profit before tax TK. Add depreciation. Depreciation is added 550. That is also right. And loss on sale of fixed assets. That is loss on sale of fixed assets. Profit on sale of fixed assets. Miscellaneous expenditure return of yes 50 is there. And next is profit on sale of fixed assets. We have subtracted. And profit on sale of investments 500. Yes, we have subtracted that also. Then 200, that is over profit and sale of fixed assets. Dividend income 402. We supposed to minus. Yes, it is minus. And everything is done. And decrease in inventories to be added 90. 110 added. 150 subtracted. 30 added. Everything is perfectly correct. And why? And tax paid they have not taken at all. Tax paid they have not minused at all. Why they have not minused? Because see here the provision, I'll make the tax provision account. Why that cannot happen, I'll tell you. This is a provision for tax account. Provision for tax. Rupees, particulars. By balance brought down, how much you have? By balance brought down, tax provision is 500. So balance carried down, nil. Okay, that means this is the balancing figure. It is coming to bank 500. This is tax paid. We have subtracted tax paid 500. We have subtracted. Okay. So why it is not coming? Might be there is a totaling error. You can check it up. There must be a totaling error. Otherwise, it cannot be not tallying. There is no reason for not tallying. I'll find out once again. I'll total all these things and I'll tell you what is the problem here. Okay. So we'll see it in the next class. I'll send this after correcting this. I'll send to you. If you total the balance sheet will not tally. You check it out. Okay. I'm concluding the class with this. See you in the next class. Any other doubts? If you want to ask, you can ask me. Problem, it is not a 4099. What we have got here is perfectly correct for the given values in the balance sheet. So there is a balance sheet problem is there. It is not 4099. It is not 4099 at all. Okay. They have taken tax paid as nil. Where they have taken the tax paid? That 500 they are not minused anywhere. The tax paid supposed to be subtracted. Okay. So the tax operating activity, cash flow from operating activity is 3599, not 4099. What is the mistake in the balance sheet? I'll find out and I shall send it to you, this PDF. See you in the next class, friends. Any other doubt? Any other doubt?
No, sir.
No. Okay, right. So in the next class, Anas, we will be going with the other areas we'll be starting. I'm not going to do the whatever is there in the next Ind AS 27 separate financial statements and other things what they have given Ind AS 28 and Ind AS 105. I'm not going to do that. Just you can go through it, and in case if you find any difficulties, let me know about it. Okay. So we'll be going for the next class. We will be completing valuation and reporting financial instruments. Okay, 109 it is there. 109. And provision for NBFs, and here provision for standard. Okay, right. So we'll be doing the next unit that we'll be doing in the next class. That is, which is the 1/4 you said on, and what is unit 4? Unit 4 is developments in financial reporting and other reporting. Okay, we'll do it. What is the mark for 5? For unit 5, EBCD, study note 5, financial statements, 275, 280, 286.
The weightage is 25%, sir.
Okay, 25%. Okay, we'll do it. This 4, 5, 6, 7, what they have given. And the next class we will be completing the 5. We will be completing. The next class I'll try to complete the 5, lesson 5. Okay, and please kindly total this balance sheet, and if you find any difference anywhere, please let me know, and I'll also sit and check today. Okay, friends. Okay. See you. Good night. Namaste. After correcting that, I will send you this PDF. Okay. Namaste.
Sir, good night.
Good night.
The OCA information, sir.
What? Which information? The balance sheet. Illustration 19 balance sheet is not in agreement.
No. That OCA PDF you told you will send, no?
Yeah, I'll send it. Okay.